Good afternoon, everyone. I'm Jim Landman in Kaufman Hall's Thought Leadership Group. It's my pleasure to welcome you to today's webinar on navigating strategic options in a transformed operating environment. Before we get started, I'd like to remind you that you can ask questions at any time using the Q&A function on the webinar platform. Also, this webinar is being recorded, and we will send you a link within the next day or two. We're also happy to share the slides with you upon request. Our presenters today include Chris Blome, Ebla Master, and Courtney Medanik, all managing directors in our mergers and acquisitions practice. And with that, I'll hand the webinar over to Courtney for some introductory comments.
Sounds good. Thanks, Jim. Thanks, everybody, for joining today. And what we're going to start with on an overarching basis is the signals that we're seeing of ongoing challenges in the market. And I know this has been an ongoing theme for many of you for some time now. But we do see a little bit of a light here at the end of the tunnel. So some organizations did show improvement in 2023 compared to 2022, which of course was really challenging. And we're seeing that that's largely due to management actions. But the recovery there has been uneven and really slower than expected. And so we do expect continued constrained environment into 2024, again, driven largely by some of those persistently high operating costs, which really just have not entirely been offset by some improvement that we are seeing on the revenue side. The pace generally in margin recovery and performance improvement are just not keeping up and not getting organizations by and large to a place where they can reinvest at a sustainable level. And so that is going to be an area of focus in the next year here. So in terms of market themes and needs, and some of these build on each other, again, we're seeing limited cash flow and margin recovery, which leads to the need for organizational flexibility. And within an environment of somewhat of a limited array of options due to some external factors, which we'll talk about in a minute, we've got a lot of organizations thinking about the longer term question, will we ever get back to pre-pandemic operations? And the rating agencies have weighed in here too, and no surprise, they are largely aligned with some of those same trends. So they continue to be negative, but are seeing some initial improvement. While demand is normalizing, rates, payer challenges, and service line shifts continue to compress margin improvement, and we're still seeing those high labor expenses and other inflationary pressures that are constraining our ability to get to a sustainable level. So that really constrains our balance sheet and our flexibility as organizations are continuing to scrutinize their capital needs and explore alternative spending strategies and really thinking about where to place bets. So our general observations are that, again, we're seeing incremental margin improvement, largely driven by some of the cost containment measures that have been underway over the last several years. There's some signs of nascent cost structure transformation, but again, not to the level to really drive that long-term sustainability. And so growth remains key, and organizations are looking at a wide variety of strategic options as alternatives continue to narrow, many of which we'll cover in today's discussion. And the key takeaway is that we're not going to be able to cut our way to long-term viability. So we've been talking in the first two slides there about sort of an internal focus. And this slide focuses a little bit more of the new environment that we find ourselves in. And so, turning the page there, we are seeing that partner organizations, the larger organizations that are looking to participate in some of the processes, are really looking at options through a much more discerning lens. They're reluctant to bring on dilutive assets unless you do see a very strong strategic rationale. And there are some situations where we are seeing that strong rationale come through. We'll talk about that a little bit later. In addition, and this has been something that I'm sure you all have seen in the news over the last year, which is the new guidelines that have been published by the DOJ and the FTC, indicating continued scrutiny of healthcare provider transactions, and that's really limiting traditional partnership options in certain markets, or at least sort of making everyone pause and think a little bit more about what might be passable and what might not be. And so time is of the essence here. And what we've observed is that sitting on the sidelines is really a decision in and of itself. And so in a period like this, where we see a lot of change and unrest, strategic moves of others around us are significantly altering the range of our alternatives in real time. And so while we may think, what's a month or a couple months going to change, and so we want to take our time, and we certainly always advocate for a very thoughtful process. Things can change pretty rapidly. And so we really think that time is of the essence. And we see that a responsive approach in this environment is really not as simple as dusting off old strategic plans for the board to gauge sustainability in this environment. They need to be proactive and really take a fresh approach to the strategic options process. And so, that's really needs to be something that's a lot more proactive, and also a lot broader than maybe we had looked at in pre-pandemic times, to ensure the high quality sustainable services going forward when considering some of these options. So maybe I'll pause there, and I know, Jim, you have maybe several questions to bounce off of us.
Just picking up off that, Courtney, this new environment that organizations find themselves in, how are strategic option assessments evolving, and perhaps specifically, how are boards approaching these questions differently than they have in the past?
Yeah, so pre-pandemic, and I'm going to overly simplify this a little bit, but a lot of strategic options, alternatives, engagements that we worked on, focused on the sustainability of an organization. And it was somewhat of a binary, can we continue on our independent path, or do we need to partner? And so building on some of my opening comments, we really believe that the most progressive boards are now, first of all, proactively answering some of these questions far before there's any real danger zones like covenant defaults and other major issues that are in the near term. And also these sophisticated boards are really moving beyond a pure assessment of the ability to remain independent and digging a lot deeper on what other alternatives might be available. And that might include other non-fully integrated partnerships, thinking about their service lines and offerings in a much more comprehensive way. And these governing bodies are really very engaged and approach those key questions with eyes wide open, and again, thinking very holistically from sort of a portfolio perspective. And maybe the last thing that I'll say is, and it kind of ties back to that last slide that we went through, which was, really getting away from sort of almost a market timing type of approach or thought process, where we say, how can we, eke our way through as long as we possibly can, but really think, again, progressively about the future and say, what do we want to do? What are our goals and objectives for our community and for the delivery of care? And how can we think about that holistically today?
And I'm going to change directions a little bit. Some of our recent M&A reports have included highlights of M&A activity in the for-profit sector. Could you describe what the landscape for for-profit systems is today and how they've evolved as potential partners?
Sure, thank you, Jim. I think in the for-profit realm, probably the most interesting trend of all, if you look at the last 4 or 5 years, the amount of hospital transactions where for-profits have been acquirers is at an all-time low level. So just sheer activity as acquirers, for-profit sector has been quiet, and so it draws a question of what's happening. And I think there's several trends here, categories. I think first, we'll talk about potentially this as we go along, but I think portfolio rationalization. You look, the most extreme example would be community health systems. When they merged with HMA a decade ago, there were over 200 hospitals, and now they're down to 70 or 71. And so but they're not alone. Tenet's had some high profile announcements. Steward has announced it's in the market. And that also comes over the not-for-profit world. They're also looking at rationalization. But I think the other kind of second theme here is focus on non-acute. So if we look at LifePoint, for example, they've made major acquisitions of assets, both in the rehab space in the behavioral health space with Kindred and Springstone. So they're looking at other areas. I think, and Julie, I believe it's slide 10 here, I think one of the most interesting examples is the tenant case study. If we look, if we could pop that up, it'll give you a great sense of what's going on for them. Is that possible to pull that up? There we go. So what we show here is tenants' mix of business, and this is really from their investor relations materials. Now they have now reported 2023, but this was leading up to that. And just some things to note here. In the bottom, you'll notice in the purple, 60% of their business was hospital related from a cash flow in 2017. And you see in the latest year now it's roughly 45%. So there's been a dramatic change. And when you think about it, just from a sheer for-profit lens, if you look at the margins, you know, hospitals 10 to 12, USPI in the surgery center business 40, and then Conifer in the revenue cycle 25%. You see the dramatic differences in margins. I also think from a compounded growth rate over the last 5 years, Tenet's USPI business, organic and inorganic, has grown almost 15% a year. So major growth and major margins. So you can see where from a for-profit lens, hey, we're going to move towards these businesses. So that's kind of the second trend. I'll say in terms of the other for-profits, HCA has stayed close to its knitting. They're looking for large markets where there's growth, reasonable demographics, and payer mix, and they've just stayed close to that and not stepped out of that. I think we also, two other categories, we do have Prospect and Steward, who are challenged by some of their financial performance and also the level of refinancing they did and the high profile medical properties trust element. But then the other thing I'd say is we've really not had any new platforms in the for-profit space have been announced in a number of years, large private equity or publicly traded. Now we do have General Catalyst new announced, at least LOI of Hatco, which General Catalyst, major private equity fund, has announced at least in a non-binding transaction with Summa Health. So there's some new transformative thinking there, and it'll be interesting to watch that. But I think all those trends together mean less acquisition activity, more non-acute, and more rationalization of portfolios.
I should ask actually a quick follow-up question on that. I think with portfolio rationalization, you suggested it wasn't just for-profit, also not-for-profit. It's happening some as well. Some of these other trends, I mean, to what extent should we look to the for-profits as kind of market leaders that will, you know, the actions that they're taking today are going to be kind of precursors for actions that we'll be seeing not-for-profit systems taking in the future?
I think a number of these trends are not just for-profit trends. If you look at other not-for-profit health systems, whether it's ambulatory or surgery center or urgent care, et cetera, you know, you look in the last few weeks, BondScore, Mercy Health, an investment. They've made investments in home health with Compassus. They've done some in the surgery center space as well with Compass. So it's not just a for-profit trend. I think you can see the same things. But I do think, you know, to some degree, you watch where the money flows in the for-profit realm, and it shows you where the return is. So I think this is an indicator, and it's by no means just a for-profit trend, but it's a good pointer, if you will.
Yeah.
Go
ahead, Chris.
I just add, so we don't think of those entities, those for-profit entities, whether they're health systems or otherwise, necessary as leaders per se. They just happen to be a lot more nimble and can move quickly to both evaluate and execute on these opportunities. At the same time, these entities are incredibly sensitive to broader market factors, financial in particular, and we've seen those deal volumes or partnership volumes for-profit entities, in particular financial entities, really come off highs, all-time highs back in 2021. So while we're encouraged at the trend towards innovation and investment in healthcare more broadly, we do see a sensitivity on the financial side. And what's really interesting, maybe back to where Eb was going with Summa and Hatco, for the past 10 years, a lot of the conversations we've had both with our health system clients and our financial sponsor or commercial entity clients and relationships have been how do we create a long-term durable partnership across the aisle, not-for-profit and for-profit, just to solve some of healthcare's issues. And I'd say again, we're encouraged by this Summa-Atco relationship as trying to be incredibly innovative and attack problems in new ways.
I guess continuing on this theme of an evolving or transformed operating environment, if we look back 10 years ago, who would the buyers have been at that point, and how the options then have looked different than they are today?
I think there's been a pretty dramatic, again, we're mainly focused on the hospital space, but we can talk about other things. We actually put together, we did a look back, and Julie, if you'll pull up slide 9, it'll give us some help here. But I think we see a pretty dramatic trend if we look back. So this is a snapshot of 2013 and then last year. And this is announced transactions in the hospital space. And these are the acquirers, if you will, on the left, on both of these. And the left is 2013 and today. So there's some obvious takeaways here, right? The number of acquirers who've done at least or more than one transaction in a year is down dramatically. So it's basically been cut in half. The volume overall was down during this period as well, but you'll see the multi-announced transactions in a given year is basically half. I think in the same trend, if you look at the for-profit names, and we do have one error, Common Spirit on the for-profit side, that's a not-for-profit, but you'll see we've gone from 6 different for-profits acquiring down to 2. So that's a dramatic difference here. The only repeat here, candidly, in the group is our new name, new entity, Catholic Health Initiatives, and it's Common Spirit, now part of Dignity together. So the group is half the size. The for-profit participants are less, and that was kind of a theme we hit already. We do have a lot of other merged names or name changes. Carolinas, as everyone knows, is now part of Advocate. HMA is part of CHS. Mission Health, part of HCA. So we have a lot, 10 years, a long time, and a lot changes. But I think to some of the things Courtney pointed out, buyers are being more selective. They are not, there's less of the focus on building a cross-country platform, although there's some doing that. But I think in terms of the level of activity, the multiple purchasers, it's more concentrated, it's more selective, and it's less repeat names in 2023 than before.
Yeah, the only other thing I would add on to that, and this was kind of an interesting exercise that we went through, sort of the full potential partner list from about a decade ago. Obviously, you see here the organizations that prevailed in some of these processes, but we went a lot wider because 10 years ago, you were much more likely to find an organization that might not even be in a contiguous market, to Eb's point, but might sort of take a flyer, even if there was an organization that might be in an interesting market that was potentially subscale. And we just don't see, again, we see organizations being a lot more discerning. And while they will sometimes participate in a very robust way, if it is a strategic opportunity, for those that are sort of outside their periphery, we tend to see organizations staying a little bit more on the sidelines.
I'm going to actually follow up with you now on, we touched very briefly on the whole question of portfolio realignment. Last week, Becker's published an article regarding some of the large national organizations realigning their portfolios. So what do you make of this, and what should we expect in the future?
So overall, our expectation is that we're going to continue to see some of this activity. And we have to remember, as we're seeing some of the announcements see the light of day now, they've been in the works for a long time. There's a long lead time to get to a place of announcement, particularly if you're announcing on a definitive agreement. So this has been in the works for some time. We expect a continuation of this. Eb, of course, just talked about it in the for-profit space, but as you mentioned, Jim, it's in the not-for-profit space as well. As some of the large organizations are sort of realizing that, at least as we've started to look at this, that in many ways regional scale seems to trump corporate scale, and ensuring that we've got sort of a robust approach and access points in our regions is really important. And so we're seeing sort of a realignment of some of those portfolios with some of the mission-based partners in their communities. And so we expect that we're going to see more of this into 2024 and beyond.
I'd just say we're also seeing a dynamic here where very large organizations, to Courtney's point, aren't afraid to look at their portfolios and potentially shrink them. 10 years ago, it was scale and growth and size. And today we're seeing a lot more emphasis on capabilities, technology, both intellectual capital and technological capital, really with an eye towards just figuring out a way to crack this margin conundrum that everyone's in. And there's not a logical solution. How do we become more efficient? How do we utilize technology as a healthcare organization for better care and access? Still very early innings on that. I don't know that others have the silver bullet, but certainly this concept of size and scale for the sake of size and scale is being meaningfully questioned at this point.
Chris, I'm going to kind of continue with you. Courtney's introductory slides touched upon the more aggressive stance being taken by the FTC and the DOJ, and we know that industry watchers are often lamenting that some of these constraints, including this kind of new regulatory hard push, are suppressing the market. But at the same time, we're seeing a handful of very splashy transactions with high multiples. So maybe you could explore a little bit, what are some of the factors behind, I guess we could call them unicorn transactions?
Yeah, I probably take that into two parts, or unpack that into two parts. There's what, if any, impact is the current regulatory environment having on deals and volume more broadly, and then there are valuation implications on that. I think the punchline is that we're not seeing any empirical evidence in terms of volume pressure, and as a result, or in conjunction with valuation pressure. There is certainly anecdotal evidence that organizations are being, as Courtney said, more thoughtful in what they approach, and what they approach opportunistically, how they spend their time, because time is a precious resource for all healthcare executives. But as we've seen, or maybe all of you seen from some of our Kaufman Hall reports, there's been a steady incline in health system announced transactions, at least coming out of the pandemic. So while the regulatory environment has, I think, gotten more challenging, we're not seeing any impact on volume. In fact, we're seeing that rebound. Now, it's off of a much lower base, but it is juxtaposed against broader M&A volumes really declining. So off the peak from 2021, deal volume across the board, including healthcare more broadly, is down 50 to 30%. Health system and hospital deal volume is actually up 30% over the 2 years. Now, Courtney also mentioned this delay effect. So these partnerships take a long time, sometimes 9, 12, 15 months to evaluate and come to fruition. So we may very well see that trend soften in the out years. I don't think we're going to see that necessarily occur in the next 12 to 18 months, assuming the broader economy stays stable. But it is causing folks to be more creative, and one of the manifestations of that is these cross-border or cross-region transactions that we're seeing so much of over the last 12 to 24 months, and then these more innovative not-for-profit to for-profit partnerships that in some respects, because they're not so geographically focused, they're more organizationally focused, don't trigger all the alarm bells that conventional wisdom for the regulators in terms of geographical and market dynamics. In terms of valuation, you know, the unicorn analogy is a good one. It's a little bit of a chuckle. Someone has to be a unicorn somewhere. Someone needs to be at the top end of the range. So you're always going to see organizations think very strategically and maybe place a premium, an appropriate premium inside fair market value, of course, on assets that are strategic imperatives for them. Scarcity value has always been a factor in healthcare providers and health systems. That is only becoming more of a factor as I think the universe starts to both consolidate and contract, and the competition for non-acute and outpatient technology assets is enhanced. So you're always going to see someone try to put a premium on these types of opportunities. The other dynamic, which is interesting, that we also hit on up front, is that margins have been compressing across health systems. So while revenue metrics or valuation metrics on revenue may be relatively stable as we look at the data, the implied metrics on profitability have looked like they've increased because the margins have increased. So what was an industry that was comfortably at 9 to 11% operating margins is now closer to 3 to 5, and that's going to have an impact, at least on the optics around valuation as well. So again, we're not seeing any empirics that are changing the math per se today, but the optics around that math and certainly how some are perceiving it do exist.
And actually, we've had an audience question come in related to our discussion of the for-profits. So have you seen any change in the board structure of for-profits over the past decade? For example, moving from a mindset of maximizing shareholder value to taking a long-term fiduciary position?
I'll start that and others can jump in. I personally have not seen a difference. At the end of the day, these boards are still, accountable to shareholders, and that hasn't changed. And so I think they have to have that same fiscal responsibility. So I don't personally think it's an interesting question, but I don't think we've seen a dramatic change from my perspective.
Yeah, I'd agree. I mean, interestingly, their fiduciary duty is to the shareholders by definition, which is, of course, for those of you in the not-for-profit space, makes sense, but it's a little bit different as a mission-based organization. I think we have seen over the past couple of years, maybe 10 years, an interest on the part of management teams to figure out ways to work with not-for-profits, and certainly, at least in the past incarnation, grow in their respective markets. But I don't know that we've seen any real change in the governance structure as a result, maybe the management structure and committee structure.
Jim, one thing I'll say back on Chris's comments on valuation, I think for the right markets, the right circumstances, there's continues to be very strong interest at valuations that are similar to the past. So those higher end, the challenge is the bifurcation has gotten greater in that those that are struggling, having a more difficult time, they're having the challenge of not only their own performance, but the buyer's performance. And so I think we will see, we have seen some more conservatism, as Courtney alluded to. So there's this bifurcation, I think, has gotten even bigger.
I think the last thing I'd maybe add on that is that it's been more and more recognized. I think that we are at an interesting inflection point in the recognition in some of these sort of mid-sized hospitals and health systems that they are thinking differently about partnership and their independent path. And there is sort of an entire, I think, cohort of organizations that maybe 5 years ago would never have thought about a path like this, and now they are sort of looking at it in a new way. So I think it just sort of goes back to the scarcity impact that Chris alluded to.
We have another question from the audience. What types of supplemental revenue programs are being targeted by hospitals and health systems?
I can start, and this is sort of more general response, but I think it's a very sort of state by state type of basis and approach. So I think there are certain programs that have popped up on a state by state basis, but there's a ton of variability, and I know that a lot of the clients that we're working with are sort of thinking about, as they think about the different paths that they may take, and certainly independence versus going forward on maybe a fully integrated partnership path, thinking about the viability that new programs will emerge, but also just sort of thinking about that from a risk mitigation standpoint and a runway standpoint. So if I'm thinking about however many months I have until I trip a debt covenant or some other major inflection point in my financial picture, am I willing to take a risk on some of those supplemental payments? Because again, I think it's just been somewhat spotty, really. Not that that's a very specific answer.
I do think in many of the states that didn't have Medicaid expansion, we've seen additional aggressive moves towards supplemental payment programs. And I think we're up to 16 or 17 states that have, or recently, over the recent years, instituted programs. So it'll be interesting to watch those, and even through potentially our election cycle, what happens with that and how does it evolve. But I think it's both that who can we appeal to from a state perspective to help us with funding, and then continue to pursue these, again, we'll call them non-acute subsectors to supplement, drive margin and growth. That's such a challenge in the acute care business.
And we have a somewhat related question, but how have hospitals and healthcare systems started to divest or outsource any particular service lines or business units?
Yeah, I mean, the short answer is that there's been many, and many different flavors of that. So I think the ones that at least pop to mind, and I'm sure Ed and Chris will have other thoughts too, we've seen a lot of monetization of the outreach lab, and partnership on the inpatient, outpatient side of lab. We've seen partnership in home health and hospice, behavioral health, inpatient rehab, and other spaces. And each of those has sort of its own unique partnership structures and partnership profiles. But we are seeing an emergence of that. And it kind of goes back to that portfolio realignment and thinking about partnership much more broadly. Certainly independent path versus a fully integrated partnerships, but also some of these non-acute paths. And I think, Chris, you were maybe about to weigh in too.
Yeah, I'd say we maybe didn't touch on it before. There's a lot of underlying conversation, discussion, and partnership volume that's not captured in some of the stats that we focus in on, health system announced transactions, or even some of the for-profit stats we're mentioning that span all of this other non-acute service line. A lot of them are joint ventures with commercial entities or for-profit entities across the subsectors Courtney mentioned, and including imaging, radiology, behavioral, so anything you could think of. There's a private equity company, a portfolio company, a commercial company that's chasing that, and in many respects relying on a relationship with a health system to create that value. In the column of potential challenged assets, I think thematically, Jim, where we were going, one area that's been of particular focus for some of our clients is how to realign the physician relationship, not only on the primary care side, but arguably on the specialty care side too. How could we create a mutually beneficial, both clinical and ultimately business relationship between a health system and its employed docs or its partner docs? And some of the numbers, depending on the market, start to get quite staggering in terms of some of the dilution that organizations are facing. And that's one I don't know that there's a really easy solution for now. It's an important one, but that's one where partnership has come up. But the question is with whom and how is it structured, and how do we make sure that we're keeping the relationship with our physicians to deliver the best care to our patients? That's one that someone hasn't solved yet.
And speaking of difficult questions, we have another one that's coming up. This is asking for a comment on the interest of rural systems in transactions, and also how the bigger systems are thinking about preserving access in rural areas to services like OB.
Those are big questions.
This is one, and we see some of this, but we don't see a lot of it necessarily. But this is one where I think organizations are really looking to either or both a technology or joint venture relationships versus the more traditional, member substitution or asset purchase or, quote, change of control. How you structure that, again, in a beneficial way while preserving as much of the care in the community, that's a challenge, candidly. We're involved in a couple of situations where the host organization really just needs to take a hard look at what they're offering there and see if they can partner up with another organization to be able to import whatever doesn't make sense to keep in the facility or the region full time.
Yeah, I'll say that I've heard a lot of interest from some of the large organizations that are in sort of what I call the periphery of rural areas, to strengthen the relationships with some of those small rural organizations. But I think that is something that's very much in process and people are looking at. So back to the key themes that we talked about, I think some of these organizations are saying, we really can't take on full fiscal responsibility for these organizations. And in some situations, they sort of still desire independence anyway. But how can we make these relationships a little bit stickier and, kind of go beyond the affiliation type of strategies that we've seen in the past, right? Where, the contracts are somewhat loose. There's really not a lot of stickiness there, but really try to address the key issues and gaps that these rural health providers are encountering, whether that's the expense of an EMR system, technology, to Chris's point, so that you can sort of, extend programs like behavioral, like others that might benefit from some of those technologies. So we haven't seen a lot of success for that yet. But it's not for a lack of trying. I think there are a lot of organizations that have that work underway now to say, how can we build a more robust affiliation program? I almost hesitate to say affiliation because I think it's almost sort of had a bad connotation in the past because there hasn't necessarily been a lot of success there. But I think that there is a lot more scrutiny on some of those programs and really thinking about how to make those programs more sticky and really yield more for everyone.
We've got another question that comes in related, I think, to your slide on the shift from acute to non-acute, right? The case study you presented earlier. Are you seeing more acute hospitals generally change their surgical mix to send more low-margin patients to ASCs when patient care is not significantly impacted? So are we broadly seeing this shift of lower acuity patients over?
I think what we're seeing is health systems trying to retain as much as that surgical volume as they can, period. And they'll, whatever means of wholly owned capabilities or joint venturing or whatever methods they need to take on, that they're really just trying to retain with all the outpatient wins and alternative platforms and everything else. I think there's just a continued effort to try several different avenues of keeping that volume in general. I don't know if others know on the acuity side. I think it's really across the board. They want to maintain those volumes.
Yeah, it's highly market dependent. No surprise to anyone. In some markets, it makes sense to bring in those assets, whether they're physician partnered or otherwise, back into the health system and consolidate. And in other markets, it makes sense to partner with another organization, whether that be a physician organization or one of the aforementioned portfolio companies or private equity. We haven't seen health systems necessarily push volume that way unless there's a capacity issue. But if there's a capacity issue, we're seeing them try to solve it in different ways, as Eb said, all while trying to maintain those procedures.
And this is maybe a continuation, not exactly what the question asked, but to the extent that I totally agree with what Eb and Chris were saying, the focus is on, sort of keeping it all in the family here, but to the extent that we are seeing an inflection point and a greater move quickly toward, say, an ambulatory setting, I think there is an increased recognition that for some health systems, they're not able to respond to those trends quickly. And so can we partner with a specialty organization who does this really, really well so that we can pivot quickly and roll out those ambulatory centers or access points through partnership with others?
We've had a question come in, which is kind of the flip side of the rural health system question, turning to urban health centers. So how are health systems thinking about the responsibility to urban centers with lower margin payers, i.e. high percentage of Medicaid, especially with local and state governmental pressures to maintain services?
I think this is challenging within the context maybe of M&A. Certainly there are sort of broader concepts here, and I know we had the question earlier about some of the supplemental payments I think many organizations are still pursuing. And maybe this is a little bit, too tangential to the core of the question, but I think actually it does go back to creative solutions for the portfolio in totality. So to the extent that you are challenged from a payer perspective and for the environment that you find yourselves in, thinking creatively about the offerings so that you're actually thinking about enhancing access rather than compressing access. So for example, in whether it's urban or rural settings, we're seeing time and time again that there are just not enough beds from a behavioral perspective for behavioral health. And so again, thinking about responding nimbly, can we partner with another organization to ensure that we have maybe even enhanced access, for example, in the behavioral health space, in an additional facility that we can launch with another organization so that we're freeing up space to service our own communities here on our own. So, I think there are a lot of creative strategies, some non-M&A strategies that Eb, Chris, and I probably won't be able to speak as well to, but I think thinking about, again, the operating portfolio and maybe a different and more expanded way is one tactic that we see, at least from a partnership perspective.
Yeah, I think unfortunately the inverse in terms of urban versus rural, we haven't seen a lot of activity, vis-a-vis partnerships try to solve. There's an inherent market dynamic there that doesn't exist in a rural community when you've got a concentrated market with many players and so forth. And as a result, while access, of course, is a huge priority on everyone's mind, using partnerships in that specific urban environment, we've seen limited success, and the financial implications are always really hard to overcome as well. So to Courtney's point, hopefully innovation technology will be able to fuel some of that, but it's probably too early to see anything come to fruition just yet. Sure, conversations are happening.
So another question has come in a time of declining margins, are we seeing an increase or a decrease in innovation and venture activity?
So we are seeing, I'd say, an increase in innovation, and I'd say venture, and venture more broadly defined is the exploration of investments and partnerships in areas that include care delivery, but may include support functions for care delivery, including other service lines. I think it goes back to that comment before, the rationale to look at strategic options and review the portfolio could very well be driven by a financial imperative, but it is also driven by a strategic imperative, a longer term strategic imperative. And if the goal, maybe back to the other points, is quality, access, delivery, consumerism, then hospitals and health systems need to continue to invest in innovation. How they do that and whether they do that on their own or in partnership with organizations is the question mark. We're seeing a lot more partnership discussions in at least in an effort to kind of synergize that dialogue and maybe even create some financial synergies than going alone. But on the flip side, we're absolutely seeing other commercial entities outside health systems invest very heavily in technology and innovation. So it almost becomes a necessity for health systems to try to keep up with that, or at least make sure that they're introducing those technologies into the system when the time comes.
I do think it's interesting. We have had several large health systems reduce the amount of internal staff focused on some of these innovation areas as they've tried to improve their own, they've had their own efforts to reduce costs internally. And so it will be interesting to watch how some health systems deal with the need for efficiency and corporate efficiency with the need to be innovative. So we see with a few health systems, they've, reduced certain titles of people in the innovation office. So there's this challenge to the immediacy of needing to maximize the bottom line, but still being very focused, as Chris said, on innovation.
That's a great point. Maybe the asterisk to my comment and what you just emphasized is health systems looking at innovation and investment for the sake of investment, and really having that be driven by financial return, an outsized financial return, almost like a financial sponsor. We've seen taper off pretty meaningfully. That's a hard thing to do when you have a whole host of other dynamics. So like, health system venture arms, and I guess, Ed, to your point, innovation offices that are doing this day to day and only doing this in the same way that others would manage a portfolio. I think that's been a challenge.
So we've had another question come in on a very high profile component of the operating environment these days, Medicare Advantage and the growth of Medicare Advantage. So have you seen hospitals and health systems in areas of high Medicare Advantage penetration struggle more with margins? And if so, what strategy are these organizations deploying to combat rapid increase in MA penetration?
So that's a great question. And I don't know that we've seen the data for that. I think what we have seen is an offshoot of that, which is large MA-focused risk-bearing entities across the country have been incredibly challenged. And I won't mention any by name necessarily, but even ones in states with a high Medicare Advantage population have seen distress. I mean, I'll just say it that way. And there have been some pretty big announcements. How that is going to either impact health systems in terms of tailwinds, we don't know. The reimbursement environment in states and the structure of those reimbursement in states like Florida, for instance, where you wouldn't expect it to happen, but it have been incredibly challenged and made the financial profile of those entities unsustainable. It has to right size itself, assuming that the payers and everyone can get comfortable that the data exists in terms of managing care and managing risk. But if you'd asked me 2 or 3 years ago where this market was going to go, I wouldn't have expected some of the higher profile challenges that we're seeing in the last 2 or 3 weeks alone.
And actually, we have a related Medicare Advantage question. It is a hot topic. What are some of the post-acute transactions that we're seeing related to Medicare Advantage plans, and what are the longer-term implications for regional markets?
I don't know that they're necessarily related per se outside of the conventional wisdom, which was how do we create a holistic continuum of care and make sure that we're shifting care to the lowest cost, highest efficiency model. And how do you do that? You need to, I don't want to say it, but control the assets. So that's the conventional wisdom, and we're seeing that manifest. I've mentioned LifePoint's focused, Tenet's focused on the space. That's clearly, just our opinion, what they're trying to build eventually. Still early innings on that, but I'd say that we'll continue to see that activity How it, I guess, merges back into Medicare Advantage is a question. I think the challenges that we're seeing with some of those, again, those risk-bearing entities is maybe causing more question marks in 2024 than we would have had this time last year.
All right, we have a question on physician practice acquisition. Are we seeing more or less physician employment, and are any systems reconsidering their physician practice acquisition or employment models?
So yeah, yes and yes. Yes to both. Health system employment still is the primary model for physician affiliation. Even with the physician practice management consolidation of the last 10 years, and I can't remember the stats off the top of my head, but yes, it has shrunk slightly, but it's by far and away the largest. That doesn't mean it's necessarily the right affiliation structure in every market for some of the reasons you heard me mention before. Depending on the system and the relationship and the market and the payer dynamic, the financial profiles of physician employment could vary wildly from accretive and mutually financially beneficial to dilutive to the health system. So yes, we are having conversations and hearing from our health system clients this question: how do we realign and make it more financially beneficial for all kind of juxtaposed against the broader consolidation in the market, and that goes for specialists too. Even high volume proceduralists, depending on the market, our health systems are having trouble making that work. And I think it goes back to the questions on a shift to outpatient. Is there a way to shift things or partner with organizations and maybe offset some of that cost?
And we've had a question come in related to value-based care. So how does all this partnership and M&A activity align with value-based care journey, whether it is through CMS or through private payers? Follow-up to the comment is the capital requirements for this value-based care work seem to align today more with the fee-for-service environment.
Yeah, I can start. I don't think there's necessarily been a de-emphasis on value-based care, but more realization that the runway of the journey is much longer than anyone anticipates or continues to anticipate. So while 3 or 4 or 5 years ago, you would probably see, outside of financial considerations, strategic partnerships executed with value-based care and the ability to import or export those capabilities as one of the primary drivers. I'd say the shift we're seeing now is more the import and exportation, not of capability, not necessarily capabilities like the do you know how to do it better than me, but of infrastructure and capital, or I think the pooling of capital to continue to build the foundation to take more risk in mutually beneficial ways. Again, when that happens and how quickly that uptick will occur, anyone's best guess. It could be this year, it could be next year. But so less of a de-emphasis and more realization it's going to take longer. Let's think more broadly about our portfolio and how it plays into the system today, and build the system of tomorrow, or at least position ourselves to build the system of tomorrow.
One thing I might add is, if you look back just pre-pandemic at our clients who we were helping find partners, I think value-based care may have been number 1 or number 2. I think financial sustainability has kind of leapt, at least for the now, and in this environment has kind of leapt over that and is top of the stack. Now, value-based care, as Chris said, is still critical, but I think financial sustainability in many cases has taken the top spot.
Yeah, I think that's right. I do think I agree with all the comments, and certainly the longer runway around all this, and value-based care and a lot of these other areas was certainly emphasized 5-7 years ago. I do think that each unique organization that may have a provider-sponsored health plan is sort of thinking about that now too, and whether this inflection point means either, you know, this isn't going to be something that we're going to need long term, and do we think about realignment of that, or, you know, is this something that is a unique capability that we can bring to the table, and we actually want to have the opposite strategy. But in any event, I think a lot of these organizations are looking really long and hard about those capabilities and wondering what to do with them at this point.
And how realistic they are about what it takes in terms of a patient member base to make it work. The bar just seems to continue to rise, again, market dependent on how much of a population you need to effectively create a value-based care structure that works for everyone. And that seems to be getting harder and harder. Certainly a dynamic that may be fueling partnership discussions and maybe back to that size and scale. But one where if health systems, in particular those with a provider sponsor plan, look in hindsight what they thought it would take, again, that watermark is probably quite a bit higher than what they would have expected.
In the few minutes we have remaining, I think maybe we just go around the screen. Ask each of you to comment on, this is broad-based, but what are your expectations looking forward into 2024? And Chris, let's start with you.
Sure. Yeah, again, barring any unforeseen events in the global economy or the U.S. economy in particular, I think we're early innings in the health system and hospital partnership, call it rebound, coming out of the pandemic. Overall deal volume may reach pre-pandemic levels eventually, but the market's changed and it's certainly consolidated. So I think there'll be an upward trajectory. Whether or not we hit 100 deals a year as we did prior to 2018 or 2019, don't know. I think what we will see, though, that volume replaced by is these not-for-profit to for-profit, or not-for-profit to financial sponsor, more innovative types of transactions that are trying to attack problems in more creative ways. And then I think we'll see, again, just with an improved public company market environment, maybe some relaxation on interest rates and cost of capital, the financial sponsor and the commercial market start to rebound. We're already seeing early innings there, coming off lows really over the past 2 years. So an active year, but an active year that may be tempered without these wild swings back and forth.
So I can go next. I think maybe building on some of Chris's comments about, certainly we're seeing kind of a pop in activity. Whether or not it's going to reach that sort of 100-ish deal a year, TBD, but I think we're counting in a different way, right? So that was like pure hospital and health system transactions, and I think we're going to continue to see a real mix. Certainly, I think an increase in hospital and health system activity, but also a lot on the acute care side as well, which sometimes we miss in those numbers. And I think also, again, depending on the lead time, we may or may not see the announcements pop for some of these, but in the meantime, in 2024, a lot of discussions, and I think a very progressive approach that we're seeing in many sophisticated health systems to really take a step back and say, if we are thinking about transformational partnerships, what are the core capabilities I have? What are the complementary capabilities I would look for in a partner? And rather than have some of the reactive strategies that we've seen in the past, really take a proactive and pragmatic look at where the gaps are and what they bring to the table.
I think more than ever, the pressure's on to multi-track here. And this hits a little bit of what Courtney was saying, to be mindful of strategic options, both for growth and for partnering, strategic initiatives, internal performance improvement initiatives. You really have to run all tracks at once. You can't just decide okay, this is off the table, it's not on the menu. You really have to keep all those out there more than ever, because you don't know what options may be available. And you don't know what may be thwarted, and you need to return to your own internal strategic plan and financial performance. So I think multi-tracking is important as ever.
All being mindful of an increasing competitive environment.
Right.
The landscape has certainly changed.
Well, thank you. That brings us to the top of the hour. And thanks again to Courtney, Eb, and Chris for joining us this afternoon. And thanks to the audience for a great slate of questions coming in today. Great discussion. We love hearing from you. And again, to remind you, you'll be getting a link to the webinar within the next day or two. So have a great rest of your day, and thanks for joining us.
Thanks, everybody. Appreciate it. Have a great week.